Welcome to the Deep Dive. I'm your guide through the often complex world of corporate earnings.
And today, we're diving into Hasbro's second quarter 2025 earnings call.
Right. Our mission, as always, is to cut through the jargon, pull out the key insights from CEO Chris Cox and CFO Gina basically help you get informed fast.
And Hasbro, well, it's a really interesting story this quarter, almost like a tale of two companies under one roof.
A tale of two Hasbros, I like that.
Yeah.
Because you've got one part just soaring and another navigating some, let's say, choppy waters.
Exactly. And understanding that split, how management's handling it, that's crucial to getting a real handle on where Hasbro stands.
Okay, so let's start with the quick snapshot. The headline numbers for Q2 2025. Overall, they're actually performing ahead of expectations.
Yeah, they stressed their strong strategic execution. Net revenue landed at $981 million.
Which sounds, just okay, essentially flat compared to last year.
Right, but like you said, that flat number masks some serious action underneath, particularly the strength in Magic, the Gathering.
We'll definitely get to that. But first, profitability. Adjusted operating profit.
It came in strong at $247 million. And maybe we should just quickly clarify adjusted for listeners.
Okay.
It basically means they've pulled out certain one-off costs, things that aren't part of the regular day-to-day business, to give you a clearer view of core performance.
Makes sense. So $247 million adjusted operating profit, leading to a margin of 25.2%.
And what's really striking, that margin is actually up 20 basis points. That's 0.2% from last year.
Even with higher royalty costs.
Exactly. Even with a, quote, material step up in royalties expense. That tells you something about the mix shift towards those higher profit areas. It's not just cutting costs, it's changing the shape of the business.
And that definitely flowed through to the bottom line. Adjusted EPS earnings per share hit $1.30.
Yep, up 7% year over year. Favorable mix, that margin discipline we mentioned. It all added up. They're getting more profit out of each dollar of sales.
Which clearly gives them confidence looking forward. They updated their full year guidance for 2025.
They did. Raise both top-line revenue and bottom-line profit guidance. They're pointing to the strong first half, obviously, but also better visibility into the second half.
So what are they expecting now for the full year?
They expect to get back to mid-single-digit revenue growth overall and hit adjusted operating margins in the 22 to 23% range. That's a pretty confident signal.
Okay, that sets the stage well. Let's dive deeper now, starting with the clear growth engine, Wizards of the Coast and digital gaming.
Yeah, this is where the fireworks are. This segment is, without a doubt, the primary growth driver. Revenue was up 16% to $522 million.
16%, that's strong.
It is, but look at the operating profit, $242 million. That works out to a segment operating margin of 46.3%.
Wow, 46.3%, that's huge.
It's phenomenal. You just don't see that kind of margin in traditional consumer goods. It really highlights the power of their IP in these formats.
And within Wizards, the story is Magic, the Gathering.
Dominating. Grew 23% year over year in Q2. It's up 32% for the year so far.
And the specific sets are just posting mind-boggling numbers. Tell us about the Final Fantasy set.
Okay, this is wild. Final Fantasy became the highest grossing Magic set ever, and it hit $200 million in revenue in one day.
One day. Compared to what?
Compared to Lord of the Rings, which was itself a massive hit, right? That took 6 months to reach $200 million.
That's incredible acceleration.
It is. Demand was so high, they increased production 4 times before it even launched, and they still couldn't meet all the demand initially.
What does that tell you about this Universes Beyond strategy, bringing in these big outside IPs?
It tells you it's not just a gimmick. It's a powerful, repeatable, and accelerating growth engine. It's bringing new people into Magic in droves.
And it wasn't just Final Fantasy, right?
No, Tarkwa Dragonstorm is tracking to be the top-selling premier set of all time. Secret Lair, their direct-to-consumer platform, had its best quarter ever, and maybe most telling for the long-term health. Backlist sales of older Magic sets have already set an all-time annual sales record. We're only halfway through the year.
So people aren't just buying the new shiny thing, they're digging into the catalog.
Exactly. It shows the depth and durability of that 22,000 card ecosystem. Everything works together.
And the community aspect seems crucial too. Record attendance at MagicCon, expanding the store network.
Yeah, the Wizards Play Network is up to nearly 9,000 stores globally. Organized play events saw unique player participation jump almost 40% year over year in the first half.
And Final Fantasy specifically brought in new players.
Record numbers. More new players in its first 2 weeks than any previous set brought in during an entire season. That's huge for future growth.
Which ties into their demographic strategy, you were saying?
Right. The average player might be 35, but these new players are often younger, like 11 to 14, so they're building that pipeline.
And actively trying to broaden the appeal.
Definitely. Universes Beyond helps, but they're exploring other themes too. Maybe romance, maybe K-pop specifically looking to bring in more female players, who are currently around 30% of the base. It's about making the community bigger and more diverse.
Okay, shifting from tabletop to digital within that same segment. What's happening there?
Expansion. They've got Exodus, that big AAA sci-fi RPG from Archetype Entertainment.
Right, I remember hearing about that. When's it due?
They're targeting the second half of 2026 for launch, expecting a major update later this year. That's their big homegrown bet.
And they're also partnering up for other digital games.
Yes, and this is significant. They just signed an exclusive publishing deal with Giant Skull.
Giant Skull.
It's a new studio, but it's led by Stig Asmussen.
Oh, the name behind God of War 2, Star Wars Jedi, Fallen Order? Big name.
Exactly. Top-tier talent. He's leading development on a new single-player action-adventure Dungeons & Dragons game built in Unreal Engine 5.
So taking D&D beyond its traditional RPG roots into premium action gaming.
Precisely. It shows they're serious about investing in quality digital experiences for their core IP. They said expect more details at the Game Awards in December. It's about future-proofing D&D.
Okay, so that's the Wizards and digital side really strong. Let's flip the coin now and talk about consumer products. A different story this quarter.
Yeah, a much tougher environment. Revenue there declined 16% to $442 million.
And the main reason was?
Primarily, that shift in ordering patterns by North American retailers. The uncertainty around tariffs made them switch from direct importing to ordering domestically.
So the threat of tariffs caused disruption, even if the actual financial hit wasn't as bad as feared.
Exactly. The estimated P&L impact for 2025 is now seen at the lower end of their previous range, maybe $60 million instead of up to $180 million. Very little actual tariff cost hit in the first half, but the uncertainty itself changed behavior.
Which is a major headwind. How are they fighting back? What's the mitigation plan?
It's multifaceted. Cost reductions, obviously, rebalancing marketing spend, diversifying suppliers. They want to get their China exposure down from 50% today to under 40% by 2027.
Makes sense.
Plus, targeted price increases where possible and boosting domestic production. But the long-term pressure is real.
Which led to that big impairment charge.
Yes, a $1 billion non-cash goodwill impairment in the consumer products segment.
Maybe unpack goodwill impairment quickly.
Sure. Goodwill is basically the premium paid for assets in an acquisition above their tangible book value. Think brand names, customer relationships. And impairment means the company assesses that the future economic benefit from those acquired assets is lower than previously thought, often due to sustained external pressures like these tariffs.
So it's an accounting reflection of the tougher long-term outlook for that traditional toy side.
Essentially, yes, a signal of the macroeconomic impact.
And on top of tariffs, retailers are just being cautious overall.
Very cautious. Managing inventory super tightly, delaying their holiday orders, pushing back shelf resets into Q3. It forces Hasbro to be really agile.
Still, they must have some positive things happening in CP. New products.
Oh yeah, they mentioned things like Play-Doh Barbie, new Peppa Pig toys, refreshed versions of Candyland in operation, Marvel Legends tied to Fantastic Four. They do expect these to help improve the top line sequentially in the second half.
And looking further out to 2026. Are they expecting a bounce back then?
Management expressed confidence in returning to growth in CP for 2026.
Based on what?
Primarily a really strong entertainment slate. You've got big movies like Spider-Man, Star Wars, Avengers Doomsday planned. Those tend to drive toy sales. Plus, the full-year impact of any successful new toys launched this year.
And they're still cleaning up the portfolio, too.
Right. Continuing to prune what they call C&D level SKUs, the less profitable, lower volume items. And they've explicitly decided not to bring some products into the U.S. if tariffs make the price point too high for consumers. It's about managing profitability in a tough market.
Okay. What about the licensing business? That seems like a consistent bright spot.
It really is. Continues to outperform, provides high-margin diversification. Monopoly Go is the star there.
Still going strong.
Absolutely. Generating about $14 million a month in the first half. They actually raised guidance for the back half, expecting $14 million a month to continue. That's fantastic high-profit revenue.
And they're expanding beyond Monopoly Go.
Yep. Just signed a big new multi-party deal in casino gaming, bringing in major players like Aristocrat, Valleys, Evolution, Galaxy Gaming, alongside their existing partner SciPlay.
Expanding into digital casinos, basically.
Exactly, expanding their brand into that lucrative digital on-premise gaming market. Another smart way to leverage their IP for high-profit licensing streams.
Okay, let's zoom out again. Financial discipline, capital allocation. Where's the money going? What are the priorities?
Priorities are very consistent. Number one, invest in the higher return growth engines, Wizards and Digital. That's top of the list.
Makes sense.
Number two, debt reduction. Get the leverage down, be opportunistic about buying back debt. Financial stability.
That's third.
Return cash to shareholders. They kept the Q3 dividend unchanged, which signals confidence in their cash flow.
And they're finding savings internally, too.
They are. $98 million in gross savings already booked in the first half. They're on track for their full-year target of $175–225 million from efficiencies across the board, supply chain, overhead, product development.
So putting it all together, this divergence, the cost savings, what does it mean for their medium-term outlook? Still expecting margin growth.
Remarkably, yes. They reaffirmed their midterm goal, 50 to 100 basis points of average annual operating margin expansion through 2027.
Even with potential lumpiness and bigger tariff impacts expected in 26 and 27.
Even with that. It shows a strong belief in the power of that strategic shift towards Wizards and Digital to drive overall profitability higher over time.
So to synthesize for everyone listening, this call really paints that picture we started with, a clear split.
Yeah.
You got Wizards and Digital absolutely crushing it, driven by magic and the universe's beyond strategy, which looks incredibly durable and expansive.
Right. It's not a fluke, it's an engine. And then you have consumer products facing real immediate challenges from tariffs and cautious retailers.
But they're actively managing those headwinds, implementing fixes, and they do see a path back to growth in 2026.
Exactly. And that big goodwill write-down in CP. It underscores the long-term pressure on traditional toys, but also highlights the strategic pivot towards those higher-margin digital and IP businesses.
So for you, listening to this, what are the key signals? What should you take away?
I think it's Hasbro's agility, their disciplined cost control, and that very focused capital allocation towards growth areas. The sustained success of Magic and Digital, plus these big new partnerships like the D&D game, it really points to a fundamental shift in what drives value at Hasbro.
They're becoming less of a traditional toy company and more of an IP and entertainment company.
I think that's a fair way to put it. The value is increasingly in the IP and the community engagement around it.
Okay, time for our favorite segment here at the Deep Dive. This is not financial advice, where we float an outrageous but plausible trade idea based on what we've heard.
All right, so building on everything we've discussed, how about this? Consider a long position on Hasbro. But the focus, the specific angle, is the market underappreciating the compounding power of universes beyond within Wizards of the Coast.
Okay, long Hasbro, focusing on universes beyond being undervalued. Unpack the thesis. Why is it underappreciated?
The thesis is the market isn't fully pricing in the long-term effects. We're talking long-tail revenue, yes, but also the massive demographic expansion we discussed, the constant innovation. Look at Final Fantasy hitting $200 million in a day. Look at the record new player growth. Look at the backlist sales setting records. This isn't just a good quarter or a hit product cycle like you see in toys. This feels more like a recurring, high-margin, community-driven revenue stream that's still accelerating. It fundamentally changes the earnings profile.
Okay, I see the core idea. What makes this trade outrageous?
The outrageous part is betting that the long-term value created by Magic, by D&D, by these digital games will significantly outweigh the near-term, potentially transient pressures on the traditional consumer products side. It's betting the market will eventually stop valuing Hasbro primarily as a toy company facing tariff headwinds.
And start valuing it as a premium digital entertainment company with incredibly valuable IP.
Exactly. A re-rating based on where the future profit growth is clearly coming from. That's the potentially outrageous upside.
And what makes it plausible? Why isn't it just wishful thinking?
The plausibility comes directly from the company's own actions and results. They're raising guidance based on this strength. They're reaffirming long-term margin expansion goals. Their capital allocation screams, we're investing in Wizards and Digital.
So the strategy isn't hidden. It's playing out in the numbers.
Right. This isn't some theoretical pivot. It's a proven engine, hitting its stride, and management is betting the company's future on it. The plausibility lies in aligning with that clear, demonstrated strategic direction.
Well, that certainly wraps up our deep dive into Hasbro's Q2 2025 earnings call. A complex picture, but the key themes seem clear. Strong strategic execution, that incredibly powerful Wizards growth engine, and disciplined management through some tough macro conditions.
Yeah, at the end of the day, Hasbro's story really reflects a bigger trend, doesn't it? The enduring value of strong IP and how critical community engagement is, especially as entertainment formats keep evolving. They're navigating that transition quite actively.
So a final thought for you to ponder. What aspect of this deep dive stands out most to you? And how does Hasbro's focus on leveraging beloved characters and stories across different platforms, tabletop, digital, maybe even K-pop themed cards, change how you think about the future of entertainment and play?